Good evening to all TradingLink partners. Once again, we've arrived at our weekly trading sharing session. Today is January 25th, 2025, and we are approaching the Chinese New Year. In Singapore and many parts of Southeast Asia, where there is a significant Chinese population, this festival is celebrated as a grand occasion. Today marks the last trading summary before the Chinese New Year of 2025. Next week, we will take a break for the holidays, and after the New Year celebrations, we will resume our sharing sessions. First of all, we'd like to express our gratitude to all our partners for trusting TradingLink and for your continued support. For over 6 months, despite any challenges, we've come together weekly to conduct summaries, exchanges, and sharing sessions. Thank you to all the traders who, over the past 6 months, have collaborated with us and contributed immensely to mutual growth, learning, and communication. The year 2025 has been a fruitful one. TradingLink's overall trading system has become increasingly robust. We believe that 2025 will continue to see significant development and progress. Now, let's get down to business and talk about this week's market trends. First, let's analyze Bitcoin. After Trump's election victory, Bitcoin experienced a sharp decline. This was primarily because his speech on the day of his victory did not include any particularly positive news for the crypto market. However, it is encouraging to note that, in the past 4 days, Bitcoin has reached historical highs without experiencing a sharp decline or showing signs of a weakening bull market. This kind of market trend is very favorable. Often, in such scenarios, there's a false breakout followed by a quick reversal. We maintain our view that Bitcoin's long-term upward trajectory is a necessity for the US, driven by strategic adjustments for the US dollar, the Federal Reserve's policies, and Trump's new fiscal policies. Bitcoin's strength is certain, and it also lays the groundwork for the US's long-term national strategy in the cryptocurrency sector. Of course, this is closely tied to its tangible benefits. Therefore, we see that Bitcoin on the weekly chart has broken above a consolidation range and shows signs of stabilization. If Bitcoin continues its upward momentum in the coming weeks, breaking through 115,000, this entire wave of market movement under Trump's second presidency might become clearly established. Therefore, in the medium to long term, it's advisable to remain optimistic. However, this excludes contract trading, as contract trading is subject to significant short-term fluctuations. Currently, many contract trades are experiencing intraday liquidations. In other words, their leverage ratios are extremely high, making it difficult to withstand price swings of more than 5,000 points. As such, their position sizing is not set up in a scientifically sound manner. Next, let's look at crude oil. After Trump's election, crude oil experienced a consecutive decline. However, this decline was not as sharp and aggressive as the typical bearish trend seen in crude oil. The main reason is that on the weekly chart, crude oil over the past 4 weeks has broken through the highs of the previous 4 months, and the moving average system remains in an upward channel. As of this moment today, people are aggressively building long positions. This includes foreign markets at levels of 116,000 and 106,000. This kind of long position building is likely based on the expectation that next week's moving average K-line will see the 5-week moving average stay above the 60-week moving average at $75.50. Thus, they consider long positions around $74 to be safe. However, one must be cautious, as in such market conditions, toward the close, if the price breaks below the intraday low of $74, it might lead to 2 more bearish days next week. This is because, currently, the market still shows a dominance of long positions. When analyzing crude oil, the position distribution data tends to be highly reliable. Market makers won't allow too many profitable trades for retail investors. The retail investors' profits are often limited. Currently, crude oil trends might evolve in 2 ways. First, on the daily chart, if today closes with a bearish candle, next week could see a continuation of bearish candles for a few days. These might be small bearish candles designed to force long traders to stop out or quickly exit their position. This type of trend has occurred frequently in history. The market might then return to a bullish upward channel next week. Thus, be cautious about today's closing at the end of the session. Of course, if the price indeed falls below $74, reaching $72, it would be an excellent opportunity to confidently build long positions. The bet is that next week's weekly candle will close above the 5-week moving average, or even above $75. Under such circumstances, this type of close could generate a potential return of 2.5 times. With a 2% position size, This could result in a 5% profit. However, this is not yet the best time to establish long positions. Since the closing period is currently around 3:30 p.m., the market from 3:30 to 4 p.m. might still display misleading movements. Therefore, exercise caution with crude oil trades. Next, let's talk about gold. Last week, we mentioned that during the previous week, the market broke through a resistance trendline. And we stated that for the entire TradingLink gold trading system, after opening positions at 2,735 and breaking above this price last Thursday, all short positions exited at cost. No closing trades were made at this point. After exiting, we abandoned this trading instrument. This was because it had already deviated from the fundamental analysis. It may have become similar to the irrational bullish trends seen in the past few months. We have now realized that our stance was very clear. From 2,733 to 2,794, there was an approximate six-fold upward surge. If one did not exit positions, what could have been a profitable trade would have been successful. However, by not exiting and returning to cost level, you failed to either close the trade or set a stop loss. This may have turned a profitable trade into a losing one. Such an error is something we firmly avoid in our trading. Therefore, for all our open positions, we always set stop-loss orders, even when in profit. This is a very prudent approach. As for this bullish wave, most of our trades have not captured it. The overall movement of gold might continue to rise next week. It could rise until a week later, when the Chinese gold market reopens, potentially leading to a downward reversal. Furthermore, be cautious about the monthly chart, as next month's opening candle might resemble those of 2023 or the opening candles of April and March 2022. This refers to a quick upward surge followed by a sharp decline, forming an upper shadow on the monthly candle. This would effectively adjust and correct the overall monthly trend. Gold is still not suitable for blindly taking long positions. Finally, let's talk about non-USD currencies. As we can see, after Trump's election, the US dollar experienced a rapid decline. I believe this is still a technical correction following 3 consecutive months of strong gains. From a technical perspective, this pullback still suggests that, in the medium to long term, the US dollar remains in an upward bullish channel. However, this recent correction in the dollar is mainly due to Trump's vagueness and softening stance on tariff policies. Many believe that a strong dollar may not be as robust as previously expected. This is also a normal technical adjustment. Lastly, let's take a look at crude oil as it stands now. In the past few weeks, it has regained some volatility. This is a very positive sign because our team excels in the energy markets. In the past fourth quarter, the overall volatility in returns was not particularly high. This seriously impacted our returns. It was around 30% of a normal month's return. However, we believe that after 2025, with traditional oil policies and energy policies, along with the changing political landscape and the escalation of the volatile Middle Eastern situation, I would like to emphasize again here, if geopolitical tensions in the Middle East escalate and Iran and OPEC are involved, if the oil transportation routes in the Middle East are disrupted, crude oil could experience rapid price surge. Such surges have occurred in a single night throughout history. A rapid increase in price could lead to a jump of $4 to $5 in just a couple of weeks. In fact, such a surge could even reach a 4 to 5-fold increase in price. That could be $40 or $50 in price movement. This kind of explosive price movement is something that should be expected. Therefore, the outlook for crude oil in the future will be based on a strategy of buying on dips, maintaining a bullish approach. As for gold, the strategy will be waiting until the bullish trend exhausts and all the short positions get liquidated before attempting to short at a higher price. As for the US dollar index, in the medium to long term, the outlook remains bullish over the coming weeks. The primary trend will remain upward. This is the market analysis for this week, our overall analysis of the market. Lastly, we wish all traders and all TradingLink fans and all our partners, as well as our asset management clients and all of our own colleagues, a very prosperous and successful 2025. We also wish everyone a joyful Chinese New Year and a happy holiday season. Happy New Year!